Good afternoon, everyone, and welcome to Prestige Wealth Management Group's fourth quarter 2025 economic and financial markets update. On today's webcast, you will hear from Prestige's founder and CEO, Roy Williams, senior portfolio strategist, Paul Esposito, and wealth advisors, John D'Angelo and Michael Williams. A few housekeeping items before we get started. This webinar will be recorded. I know the last webcast we had some technical difficulties, which made us not release that as a webcast. The audio is a little messed up. We have remedied that since then, so please be on the lookout for the recording for this webcast. Additionally, if you guys do have any questions, please feel free to send those in at pwm@prestigewmg.com, and we'll be sure to address them. Just one caveat on the questions. We get a couple kind of very specific individualized questions that are kind of very tailored to that specific individual. We usually don't address those on these webcasts since we have a broad audience, but if you have any general questions about the markets, economy, please feel free to send those in and we'll be sure to address them. With that, I'm going to pass it over to Paul Esposito to get us started.
Thank you very much, Michael. All right, so I guess we're going to first start out with the state of the U.S. economy. They're obviously in the fourth quarter with, the government shutdown and, the lack of transparency with data. A lot of the estimates had been, at least by, blue chip consensus, very conservative. Atlanta GDP Fed usually has a pretty good pulse on what economic output is going to look like. Despite them being a little bit more optimistic than blue chip consensus is cited here in their GDP Now cast. But we had probably a large revision right around June 8th, and that was really a result of net exports actually increasing. I know there was a little bit of conflicting data with the International Trade in Goods and Services report this morning, which showed for at least November that the trade deficit had widened by about $57 billion, where we saw a drop in exports of about 3.6% and an increase in imports by about 5%. But nevertheless, that really didn't impact the GDP estimates because it's not accounting for the October read as well as December, which December's will more than likely come out. I believe February 19th is that release. But as of now, GDP is expected to print about 5.4% for the fourth quarter, and most of that coming from personal consumption expenditures, which got revised from 3.1 up to 3.2%. Real domestic investment, gross domestic investment was up from 6.2 to 6.4%. Government spending, although elevated, it was still somewhat muted. But the primary reason why we saw that jump up, from 2.7 in early January to the 5.4 where we see now is really just improving net exports and trade data along with inventories. We do anticipate consumption will decline in the coming year, mostly due to trade volatility and just a more constrained consumer. So we probably would expect GDP to subside more in the traditional range of 2.5% to 3.5%. And of course, this cooling growth certainly supports a dovish Fed, or at least a Fed that is currently on hold with a rate cut policy. As for unemployment, we did see December's number come down. Unemployment rate now stands at 4.4%, slightly under the November print for 4.5%. Again, this is mostly due to a trend, if you look at the left chart, in the labor participation rate. So overall, the labor participation rate for the U.S. working age population has declined. It's actually been on a decline trend, but most notably just within the last print to 62.4% of the approximately 171 million working age population for the U.S. So that's, if we were to put it round figures, you got 165 million employed in the U.S. and about 7.5 million unemployed in the U.S. But the large trend at hand is that if you look at the age brackets, age brackets 25 to 54, that participation rate is almost at 84%. It's 83 and change. And then if you look at the 55 plus bracket, it's barely above 38%. Well, that's primarily due to the trend in retirement. So although it's showing a decline in labor force participation, at least the trend's going in the right direction. You want more of your prime age working group, ages 25 to 55, expanding, while those that are 55, 60, 65, 70, it's only natural to expect them to have attrition due to retirement. So overall, that actually shows a lot of stability in the labor force. If we look at the right-hand chart in initial jobless claims, this is certainly supportive. Initial jobless claims for January is down to just 209,000. It's slightly above some of the economists' estimates. Claims for December averaged below 200,000 range. Again, consistent with a cooling but stable labor force. The December jobs report did show weak payroll growth. It was about 50,000 below expectations with downward revision in prior months, capping a soft 2025 for hiring compared to prior years. The labor market still, again, remains very resilient in a lot of ways. You have low claims, a stable prime age participation, but with signs of some cooling momentum. So overall, a stable labor market will make it tough for the Fed to continue to justify additional cuts if the labor market doesn't weaken in the upcoming months. The Conference Board's leading economic indicators, that's on the left-hand side. This is an index that's comprised of 10 most notable economic indicators and provides a more holistic view of economic conditions. It includes data such as manufacturing hours, initial jobless claims, stock prices, interest rates, and credit indices. It also includes business and consumer confidence readings. As of November, the reading in the index did decline by about 0.3% month over month, and it did contract about 1.2% over the prior 6-month period. This was a lot slower than the pace for the first part of 2025. If you recall, it was down almost 3% during the first half, as we obviously had a lot of gyrations and tariff policy uncertainty. However, the ongoing decline has more so been a function of consumer expectations due to policy uncertainty and new orders. If you're a manufacturer, obviously, new orders are going to be very difficult to come by and gauge. Of course, tying this back to the lack of transparency in tariff policy for the year. Some of the positive offsets, however, did come from initial unemployment and average manufacturing hours. But as you can see, that the index itself has been under pressure, below a positive reading, for the better part of the last few years. So although in late 2023 till present, it's sort of marched its way into being less negative, it's still residing in a range that, again, is showing a little bit of concern, but at least heading in the right direction. As for the state of manufacturing and services in the U.S., you've got the right-hand chart, which depicts the lighter blue color is the ISM non-manufacturing index, or PMI. That's still healthy and expansionary at above a 50 reading. That's about 54.4 was the most recent reading for December. whereas the manufacturing index print is still down below 50. It was at a 47.9% reading. And again, this does show at least health for the overall U.S. economy. We are predominantly still a service-based economy. Of course, there is still, some concern on the manufacturing end, because normally, in order for the economy to be on, running on all cylinders, you normally want both of these to be, above 50 or in the expansionary realm. So these are figures that we're going to keep close eyes on, just to see if there's, any further deterioration in either services or manufacturing. But, given, the collection of data that we see at present, the shape of the U.S. economy seems very benign heading into this year. That said, I'm going to pass it on to Roy to discuss inflation and the Fed.
On recent release on January 13th, the numbers released, you had a 2.7% year-over-year inflation rate, which again, that is very positive. When we look at core inflation, which excludes food and energy, everybody says, well, why would you ever exclude food and energy where it's a big part of our budget? It's, the lowest since 2021 at 2.6%. When we look at shelter housing in New Jersey, when clients are listing single-family homes, they're selling rather quickly. Single-family homes, even condos. So it depends which state you're in. We've had clients in other states, have more challenges. It depends how much building is going on in the area. For example, in South Carolina, there's a huge retirement community going up. So if you're trying to, and there's tons of new home inventory. So if you're trying to sell your home, you may have to, reduce prices. There may be some more pressure when it comes to that. And, if you look at rentals for young people today, graduating college, I just had a friend of mine, she couldn't afford an apartment on her own, so she split a 4-bedroom place with 3 other friends to have it come in at $1,500 a month. It's very difficult to find a rental in New Jersey. All the rentals are, Paul and I were discussing this not long ago. All the inventory they're building in Millburn, which is hundreds and hundreds of units, and they start at $3,000 a month for a 1-bedroom place, and they go up to $6,000 for a 3-bedroom place. So for a rental, for an apartment, so the cost of shelter has been a challenge. Imagine now your child is trying to buy their first home. They get married, they have their first child, now they want to buy a home. Mortgage rates are still at above 6%, 6.25%. So it does become a challenge. Another big component, food. When you look at food, you got to look at the downsizing part of it too. I just yesterday had my wife pick me up some almond butter. It used to be 16 ounces, now it's 14 ounces, and the price is significantly higher than it was a couple years ago. So again, it's I hear from clients all the time that food is grocery shopping is expensive, is very, very expensive, especially if you have a family of 4, or if you have a gathering. It's not uncommon if you have a gathering of friends or family to spend $300 to $500 on groceries for that gathering. It's especially if you're buying steak. Energy has been a benefit. Energy prices have continued to slide a little bit. They popped a little bit recently, but again, that's been, when you can pay, this morning I filled up near the office in Flemington, it was $2.95, but by my house is not a name gas station, and they're $2.75. So that's, for regular gas, that's a real benefit economically in helping. But when we look at it, a big thing that it's really not accounting for is insurance costs. Homeowners and also auto insurance has gone up exponentially, significantly more than inflation. So, again, inflation overall has been, I'll call it benign. But I mean, it's still there, depending upon every consumer is different as to their budget and what's the major piece of the budget. So, again, we'll keep an eye on that as we go forward, what's happening. The Fed, when we look at the Fed, and this is the potential for a hike or a decrease. As we go forward, when we look at, September, it's at 39%. In June, you're looking at 46%. So one thing that's going to happen after June, we're going to most likely have a new head of the Fed. And again, depending upon who that person is and what their policies are, we'll see what happens with interest rates. If we're talking about inflation, it's tough to buy a used car today for young people. Rates could be 8 to 11%, depending upon their credit score. And even unless they're running specials, new car interest rates, you're still looking, 6 to 7%. So, we'll see what the Fed does. Hopefully the Fed, I'm personally hoping they decrease rates a couple more times in the next year. And again, that'll help a lot of the shorter term financing. With that, we'll have John talk about the markets.
Yeah, thanks, Roy. Been a quarter or two since I went over S&P 500 valuation, and I hate to be redundant, but valuations remain, I would say, stubbornly high on a historical basis. We're looking at north of 22 times earnings. Average stock price valuations, typically are usually in the, call it 16 to 17 times range. And I think as long as growth continues to be robust, I think that the overall stock market can continue to be constructive. But it'll need to be robust for the market to continue to justify these higher inflated multiples. And I think today is really indicative, a good example of the need for robust growth when we look at a company like Microsoft, which reported earnings last night, and the stock's down, call it 10 or 11% this morning. Not that they didn't have outstanding earnings; they had a very good earnings report if you look at it in a bubble. But the need for cloud growth to be exponentially high within the numbers. Microsoft reported call it a softer than expected number, although a very good number, a very high growth number. The fact that they reported below consensus and then gave a little bit of a soft forecast for next quarter, you can see that the stock got punished today. And it got punished because, Microsoft is trading at historically high multiples because of the excitement around, their ownership interest in a company like OpenAI and some of the prospects around being a hyperscaler. So we'll have to see on a go forward. You kind of are looking at a 493 stocks versus 7 when you think of the S&P, and perhaps we'll see a little bit of call it a broadening out. But if we get a broadening out of stock performance, the stock market might look a bit muddy, and I like to get into that in the next slide. So when we look at the S&P 500 index, we look at the concentration of the securities. I find this really an interesting slide that we haven't looked at before. And it reminds me quite a bit of, and some people who have been investing in the stock market for quite a while. It reminds me back when the market talked about the Four Horsemen. The Four Horsemen back in the late 90s, and if you look at the early part of the chart on the left, you see where the stock concentrations were up north of 17.5%. And there were 4 stocks at that time. It was Microsoft, Cisco, Intel, and Dell. And those stocks had a high concentration of index. Today, when we look at the top 5 stocks, and really we're talking about Mag 7 stocks, they're north of 30% of the index by market cap. So we can actually have a period where the overall stock market broadens out. Maybe the other 493 stocks perform pretty well. But if we get a repricing or we get some type of a correction among some of those mega cap growth stocks, stock market performance may not be stellar during that time period. So again, we'll have to see, kind of how the rest of the year plays out. I think if those 7 stocks continue to exhibit, I'll call it robust growth, perhaps we see a constructive market on a go forward. If not, maybe we haven't seen a correction since the tariff tantrums early last year. We could see a short-term correction somewhere within that space. Might not be a cycle killer. It might be a short-term repricing. We'll have to see, but we're going to pay very close attention to those factors. So then I'll pass it over to Michael to talk a little bit about fixed income.
Yeah. So the chart you're looking at right now shows kind of the history of the yield curve. The darkest blue line is showing the current rate, and then the little lighter blue is 1 month ago and 1 year ago. And one of the things that you're going to see, and just by looking at the shape of the yield curve, is that there is what's called a steepening effect, where that short end of the yield curve all the way on the left-hand side has come down, while the right-hand side of the curve has still remained pretty, around 4.5%. And one thing I always like to point out, and we have a wide variety of people on the call and their knowledge base of the markets and fixed income, is that when we talk about the Federal Reserve and kind of what area of the yield curve they control, we are talking about the very left-hand side or the short end of the yield curve. Now, they have an influence on the longer end of the yield curve, but as far as directly lowering rates, when you hear people talk about lowering rates, they're talking about that left-hand side. The longer you go out, the 10, 20, 30 years, those are largely driven by supply and demand and also expectations about future economic growth. And one of the things you see that with the steepening of the yield curve, one of the indications is that economic growth is likely to remain strong going forward per what the yield curve is influencing. But also, and one of the things I'll talk about in a minute is one of the impacts of the Federal Reserve cutting interest rates. There are some positive effects to maybe the stock market and some other areas, but there's also some negative effects that will probably directly influence our clients and some of the ways that they hold, especially their cash assets. But looking at fixed income yields, this next slide goes through the historical relationship between the starting bond yields and actually the overall return that they provide. So it's important to remember that when you are buying bonds, your return is driven by 2 things. It is the actual coupons or interest that you're earning and also the price appreciation potentially. And one of the things you'll see, this is broken down by decade, but in the dark green on the very bottom left was the 2020s. And for a very long time, yields on bonds were very, very low and completely insignificant. We had some questions from clients asking kind of what is the value of bonds. We still think that bonds do provide a ballast at the time. But the nice thing is if you look at where that gray dot is right there, the starting yield right now is closer to 4.36%, which is a pretty significant increase in starting yields and actually provides a lot of value for bonds going forward. One of the things that we heard over and over is that the 60-40 portfolio is dead, or like bond returns are never going to return. And this is kind of, we never believe that. And this is kind of to that point where we do believe that clients should have a bond allocation as they approach retirement. And one of the benefits right now is that they're getting a good sized yield. And there's also going to be a benefit if the Fed does continue to cut rates and that sort of thing. There could be also a pickup in price appreciation as well, which is also a positive thing. Finally, this slide is an oldie but a goodie, and it's always nice to revisit. This is a slide that shows the theoretical return of a $10,000 investment of 4 of the largest asset classes: large cap stocks, small cap, corporate bonds, and cash. And there's a few key takeaways you can take from this chart. One is just the power of staying invested. And, the old saying that it's the time in the market, not trying to time the market. And you can see all sorts of downturns, whether it's from COVID or the 2008 great financial crisis. And if you stayed disciplined and you stayed invested regardless of the volatility, you were obviously rewarded. One of the things I also like to point out, and something that I kind of bang the table on religiously with my clients, is the impact that inflation has on the cash assets you hold. As you can see, that large cap stocks grew to 90,000 from that 10,000 investment, small caps 55, 24. If you look at cash has actually lost value in real terms. And as one of our favorite economists, Dr. Jeremy Siegel, kind of emphasizes in his research, the only thing that matters, and I will emphasize that again, the only thing that matters is after inflation adjusted returns, right? So if you have cash in the bank, you don't see it, you don't feel it, you don't taste it. There are little inflation bugs eating away at the value of the dollars in those accounts if you do not have them yielding something. If you look at the traditional savings account, I've looked at this for Wells Fargo, Bank of America, a lot of the major banks, they're offering a 0.01 or 0.02% yield. That is not enough, especially with inflation running close to 3%, right? So in real terms, you could be losing value. So what the takeaway is for our clients, stay invested. You're going to be rewarded by remaining disciplined from those other asset classes and what they show. But if you do hold a decent amount of cash, it's important to keep that in perspective, right? It's important. Cash serves a purpose, but holding too much cash, there are some negative effects. And the main negative effect is inflation will eat away at the value of those dollars over time. So just try and keep that in mind. Try and work with your advisor to make sure that if you do have any excess cash, it's at least getting as much yield as possible. It's not just sitting there idle, or looking at some other avenues to invest that money for the long term and yielding something that's going to yield well in excess of inflation. And with that, we want to thank you guys for joining us. Again, if you guys do have any questions, please feel free to send those in at PWM@PrestigeMG.com, and we'll be sure to get back to you. And we'll talk again next quarter, guys. Thank you very much.